This is Satya Pradyuman of Cirrus Research. The latest monthly issue of Signals, the Signals report is just out. The Signals report is an asset allocation report that looks at the various key models that we track. Stocks versus bonds, large versus small, growth versus value, and so on. The title of this report, Indicators Urge Value Offset to Trending Extremes. At the heart of this is that we have a fairly constructive equity market. The asset allocation models has remained staunchly overweight equities pretty much for the last year, pretty much nailing down a very positive equity market for all the right reasons. We continue to argue that easier credit, bottoming profit cycles, these things are good for risk assets. The nuance here is really the risk of a market rotation. And we continue to argue, given the severe run of the specific themes such as AI that have been running, at some point, those rate of change begin to slow. This current cycle, the global profit cycle, is bottoming, which typically argues for more of a value rotation. So this is especially notable in an environment where central bankers are beginning to cut rates and pare away. That said, this concern could be offset for several months or maybe even a quarter or two. Two key elements that we continue to reiterate. One is risk appetites are starting to stabilize. They're starting to rebound. We find that your highest expected return are when risk appetites are more neutral. The fact that risk appetites are not frothy says that there's more room for leadership to run. And also in terms of crowding, as much as we're measuring crowding and we recognize that a handful of companies are driving the market returns, also punishing most other asset returns, the reality is that the earnings growth in these companies have been very strong. So our crowding model, while it flashed a red signal in early spring, March, April, by the sell-off in April, this model reverted back to a neutral reading. In other words, what's going on is the strong rotation that we've seen towards the thematic-based companies. They're making a lot of money. They're earning their way into their multiples. The big risk here is that at some point, a 200% top-line grower will likely stumble. And so we do believe that the profit cycle supports more of a value-sensitive rotation. Take a look at the quarterly report. We underscore the need to basically use a barbelled approach to model the profit cycle realistically and potentially continue to take these more systemic risk bets. With any questions, feel free to reach out. Thank you.